Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Nebius Group.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock. If you trade stocks, crypto, forex, gold, or indices and want clearer buy and sell signals, you can check out VIP indicators through my link below. Grow $100 to $10K with VIP indicators. VIP Indicators offers TradingView indicators, market alerts, trading education, and chart reading support with up to a 93% win rate. The tools are designed to help traders spot possible setups faster and trade with more confidence. But please remember, trading is risky. No indicator can guarantee profits, and growing $100 into $10 is not guaranteed. Use these tools for education and analysis only, manage your risk carefully, do your own research, and never trade money you cannot afford to lose. This is an affiliate link, so I may earn a commission if you use it at no extra cost to you.
All right, let's jump right into the hook for today because honestly, the number we were looking at are pretty staggering. Nebius Group is up, 134% year to date? And it's all being fueled by this totally insatiable demand for AI compute.
Yeah, the market is obsessed with them right now.
Yeah.
And if we want to figure out if this is a sustainable compounding machine or just, peak AI euphoria, we have to start with their Q1 2026 earnings.
Right, because I read that report and I honestly thought it was a typo. A nearly 700% jump in revenue.
Exactly. Total revenue surged 684% year over year, hitting $399 million. And it gets crazier. If you just isolate their AI cloud segment, that specific division skyrocketed 841%.
Wow. Over 800%. I mean, general cloud giants like AWS or Azure aren't doing that.
Not even close.
So, all right, let's move into the wealth building context. To understand how they jumped 800%, what exactly is Nebius building that those legacy players aren't?
Well, it comes down to architecture. A traditional cloud provider operates like a massive general-purpose warehouse. They host websites, store HR data, whatever. But Nebius calls itself an AI-native hyperscaler.
Meaning what exactly? Like a server rack is just a server rack, right?
Far from it, actually. When you're training a massive AI model, you have millions of processors that need to talk to each other simultaneously, right, with zero delay. If you run that in a generalist cloud, the network gets totally congested.
Yeah, so just bottlenecks.
Yeah, the processors overheat, the whole system lags. Nebius, though, focuses entirely on full-stack integration exclusively for AI. Every fiber optic cable, the liquid cooling, it's all purpose-built to just push data through GPUs as fast as physics allows.
And when we say GPUs here, we're really just talking about NVIDIA, which brings up a note in the filings that really caught my eye. NVIDIA actually put $2 billion of equity into Nebius via pre-funded warrants.
Yeah, that's a massive validation.
Right. And for those listening who don't read SEC filings all day, pre-funded warrants basically mean NVIDIA bought the right to own shares and paid for almost entirely upfront, yeah.
That's spot on. It's a locked-in financial commitment. But that $2 billion is just a symptom of a much deeper alliance. Because of this, Nebius got what's called NVIDIA Exemplar Cloud status.
Oh, on the new GB300 NVL72 architecture, right. Let's pause there, because getting those specific chips right now is basically impossible.
Oh, it's a total knife fight.
Yeah.
Everyone from governments to huge tech conglomerates is fighting over that supply chain. But having Exemplar Cloud status means Nebius bypasses all of that. They get guaranteed priority allocation globally.
It's like, okay, let me try this analogy. It's like you're building a massive high-speed rail network, and the dominant train manufacturer doesn't just sell you the trains, they hand you $1 billion to fund your tracks.
Yeah, exactly.
And then they legally guarantee you priority delivery of their absolute fastest locomotives before anyone else even gets a look.
That is a perfect way to put it. NVIDIA is essentially deputizing them as the global showcase. But there's a catch. Having all those bleeding-edge chips is great, but they are incredibly power-hungry.
Right, which grounds us in the physical reality of all this. It's not just software. It takes so much electricity.
A mind-boggling amount, and that's Nebius's real moat. They are operating at the gigawatt scale. They have over 3.5 gigawatts of contracted power right now, targeting 4 gigawatts by year end.
Let's not gloss over that word, gigawatt. I mean, a single gigawatt is roughly the output of an entire nuclear reactor, right? Enough for a mid-sized city.
Yeah, and they're securing 4 of them. The crown jewel is this massive 1.2 gigawatt AI factory they're breaking ground on in Pennsylvania.
Okay, let me play skeptic for a second. Isn't building data centers just standard procedure? Why is Wall Street so obsessed with the fact that Nebius actually owns 75% of this contracted capacity?
It's all about cutting out the middleman. When generalist clouds need capacity, they usually lease from third parties, like Equinix. And those middlemen mark up the raw power, the cooling, everything. By owning 75%, Nebius completely insulates itself from those markups.
All right, now let's look at the fundamentals, because I'm guessing cutting out that middleman shows up on the bottom line.
Oh, the margin expansion is historic. A year ago, their AI cloud segment posted a $27.4 million loss. In Q1, that swung to a $174 million profit.
Wait, a $174 million profit in one quarter?
Yeah, they hit a 45% adjusted EBITDA margin, up from 24% just the quarter prior.
How do you double a profit margin in 3 months?
Operating leverage. Because they own the infrastructure, adding one more customer costs almost nothing. Their cost of revenue plummeted from 49% down to just 26%. Fixed costs stay flat, revenue goes vertical.
Okay, but hang on. Digging through the financials, I found an anomaly that honestly looked like a huge red flag. We said Q1 revenue was $399 million, but their GAAP net income was reported at $621.2 million.
Yeah, that math breaks a lot of automated trading algorithms.
Right. Like, how does $399 million in revenue turn into $621 million in net income? Is that some sketchy accounting?
It's actually just very strict accounting rules. That GAAP net income includes a one-time $780.6 million revaluation gain on their stake in a data management company called ClickHouse.
Ah, okay. So it's a paper gain on an external investment, not cash from selling cloud compute.
Exactly. So if you want to see the real health of their core business, you have to look at annualized run rate revenue, or ARR.
And the ARR is wild on its own. It hit $1.92 billion. That's a 674% year-over-year jump.
Yeah, and ARR strips out all that noise. And management is guiding for that ARR to hit between $7 billion and $9 billion for the full year 2026.
Okay, that brings us to the catalyst timeline. What are the specific dates or events we need to watch to see if they actually hit those massive targets?
2 major catalysts are coming up. First, Q2 2026 earnings in August. We need to see if that sequential revenue is actually accelerating toward that $7 billion to $9 billion target.
And if they raise their full year guidance, that's a huge positive trigger.
Absolutely.
Yeah.
The second catalyst is physical execution. In Q3, we're expecting concrete construction milestones for that Pennsylvania factory. When they connect that to the grid, it immediately unlocks recognized revenue.
All right, now let's pivot to the chart, because the technicals here are really interesting given the massive run-up.
Yeah, the stock is up 134% year to date, which is incredible momentum.
But it recently took a 9% pullback, right? And it's actually retraced about 15% from its all-time high.
It has. Even with flawless earnings, the valuation gravity on this stock is intense. It's priced for absolute perfection, so any slight broad market weakness or sector rotation pulls it down hard.
So what does market sentiment look like right now with that volatility?
It's fiercely divided. On the bullish side, you have Citigroup and Citizens JMP raising price targets all the way to $287. They see the 800% growth in the NVIDIA warrants and say it's an obvious buy.
But then you have D.A. Davidson. They actually downgraded the stock from buy to neutral based purely on valuation, even though they raised their target to $250.
Yeah, they basically argued the stock price is totally disconnected from reality.
Now let's talk about the risks, because that D.A. Davidson downgrade leads right into the bear case. Expanding multi-gigawatt infrastructure requires a terrifying amount of cash.
It's one of the most capital-intensive build-outs in modern history.
Right. Let's look at the debt reality. In Q1 alone, their CapEx cash spent on physical servers and concrete was nearly $2.5 billion. And they just raised full-year CapEx guidance to, $20 billion to $25 billion?
Which is astronomical for a company projecting $3.4 billion in recognized revenue this year.
Right. And they only have $9.3 billion in cash, but $8.45 billion in debt. So explain this to me. How do they pay for a $25 billion expansion without issuing a mountain of new stock and diluting shareholders?
It's a brilliant strategy, honestly. They are utilizing asset-backed financing.
Meaning what? Like taking out a loan against heavy machinery?
Sort of. Think about a mortgage. A bank lends you money because it's backed by the physical house. Nebius is doing that, but the asset they're using to secure the debt is their blue-chip customer contracts.
Wait, the contracts themselves are the collateral.
Exactly. They have $33.58 billion in remaining performance obligations, or RPOs.
And RPOs are legally binding signed contracts for future services, right?
Yes. Guaranteed future cash flow. And the anchor of that is a $27 billion agreement with Meta.
Okay, so when Nebius goes to Wall Street for a loan, they just slide a contract from Mark Zuckerberg across the table and say, Meta owes us $27 billion, give us the cash to build the building.
That's the exact blueprint. Securitizing these cloud buildouts means they get multi-billion-dollar loans at attractive rates, completely bypassing the need to crush their own stock price with new shares.
That's incredibly clever. But the valuation risks D.A. Davidson brought up are still glaring. Nebius is trading at roughly 16 times forward sales.
Yeah, not earnings, sales.
And the forward price-to-earnings ratio is hovering over 800x. Plus, there's the macro risk, right? The 30-year U.S. Treasury yield recently touched 5.18%.
That's a huge factor. High interest rates act like intense gravity on growth stocks. If institutional investors can get a risk-free 5.18% from the government, Nebius has to grow at a terrifying velocity to justify its risk profile.
And beyond the macro, there's the competitive threat. I saw rumors in the research about Google and Blackstone teaming up for an AI infrastructure joint venture.
Yeah, the deep pockets are circling.
If everyone starts building gigawatt AI factories, doesn't GPU compute just become a cheap, commoditized utility? Like, aren't they just at risk of becoming over-leveraged GPU landlords?
If they were just racking servers, yes. Commoditization would crush those 45% margins. But this is where their software moat kicks in. They've been aggressively acquiring software startups like Tavily, EigenAI, and Clarifai
Why does an infrastructure company need AI software startups?
to build their token factory. It's a full suite of software tools that helps developers run inference and build agentic workflows.
So if the GPUs and the power grid are the engine of a car, the token factory is the steering wheel and dashboard.
That is exactly it. And once a developer learns to drive using that specific dashboard, making them switch to a competitor means relearning how to drive completely. It creates incredibly high switching costs.
So it's real developer stickiness. Okay, so with everything on the table, what's the final verdict?
Synthesizing all the fundamental data, the thesis yields an 8 out of 10 bullish score.
That is a very strong conviction given the 800x PE ratio.
Well, it requires a clear, long-term, multi-year hold perspective. They are one of the purest public market plays on the ultimate bottleneck of AI power and compute. The valuation will cause severe volatility, sure, but the intrinsic value of privately owned power, backed by a $33.5 billion contract backlog, profoundly outweighs the near-term macro risks.
It really reframes the whole sector. I want to leave you, our listener, with one final provocative thought today. We talked about how Nebius is using $33 billion in cloud contracts to secure debt like a mortgage, locking up gigawatts of the world's electricity. If massive tech giants are signing legally binding multi-billion-dollar contracts years in advance just to guarantee access to GPUs and electricity, are we witnessing AI compute transition from a simple tech service into a new foundational global asset class? Almost like a new reserve currency, but backed by processing power and electricity flowing through Pennsylvania. It's definitely something to think about.
It really is.
And if you want extra help reading trading charts, you can check out VIP indicators through the link below. The campaign is grow $100 to $10K with VIP indicators, and their tools include TradingView indicators, market alerts, and trading education with up to a 93% win rate. But trading always carries risk, and no profits are guaranteed. Use the tools for education and analysis, manage your risk carefully, and always do your own research before making any trade. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.